Okay, so chapter 15, part 2. We pick up with a little different area, still dealing with laws assisting creditors. So in some instances we have what's called a suretyship or a guarantee. You've probably heard of this before. This is simply where a third party promises to make payment on behalf of the debtor in a given situation. What it does is it creates a right by the creditor to go after that third party. Okay, so you see that there. So a suretyship is an express promise by a third party, the surety, to a creditor to be primarily responsible for the debtor's obligation to the creditor. Guarantee: with a suretyship arrangement, the surety is primarily liable for the debtor's obligation. But with a guarantee arrangement, the grantor is secondarily liable. The guarantor only has to pay if the principal defaults. So there's a slight difference between the two. Oftentimes these are situations where the person who is going to owe the debt does not have a good credit history, and therefore the person who is extending to them some form of credit is not willing to do so without somebody else standing in as a surety or a guarantor. The next topic is mortgages. Okay, mortgages are, of course, can be on real property or personal property. Here we're talking primarily about real property. Okay, so when a person borrows money to buy some real property, normally, or not normally, but in most cases, people don't pay cash. They borrow money to buy the property, and that money comes from a lender. Okay? So the person who's borrowing the mortgage is called the mortgagor, and the person or entity giving the money is called the mortgagee. And the mortgage itself is a written instrument that is a contract that shows the lien on the debtor's real property as security for payment and all the other nuances of a mortgage. Okay, now there's at least two types of mortgages that are common with lending institutions. One is a fixed rate mortgage where you pay a certain amount of interest, a percentage, over the course of the loan, and that stays the same. The other is an adjustable rate mortgage. In an adjustable rate mortgage, you pay one rate when you start with the mortgage, and then it's adjusted on a periodic basis. And that period of time is set forth in the agreement, and it can be based on a time period itself or changing conditions in the economy. Generally, people enter into fixed rate adjustable mortgages when they can get a low entry interest rate that is expected to possibly increase, but the folks who are taking it are expecting an increase in income, which is what most people expect over their lifetime. Adjustable rate mortgages are one of the causes of the recession back in in 2008 and 2009. Mortgage companies were pushing adjusted rate mortgages, and people were taking them out so that they could buy more expensive houses than they could actually afford, thinking that as the mortgage rate adjusted upwards, their income would also adjust upwards, and because property values were increasing at such a big rate, it wasn't much of a risk. The problem is that when the recession started, people weren't getting raises, they weren't getting new jobs, and the value of real property was not increasing as much as it had, and it resulted in a lot of people defaulting on their loans, which added to the problems of the recession. Okay, so I kind of covered all that. So one of the things about a mortgage is it's under the statute of frauds and therefore has to be in writing. There are a lot of provisions that should be in a mortgage, and here are some of them. You have to provide the borrower has to make sure the house or the real property is insured, maintain the property, not get into any other financial obligations that might impede the value of the property, other protections that exist. One of them is called private mortgage insurance. So if you buy a house, for example, and you can't put down a down payment more than 20% of the cost of the house, the mortgage company will make you buy this extra insurance so that if you default, the bank gets coverage from the insurance. Okay. Now in Georgia, we don't call a mortgage a mortgage. You know how Georgia likes to do everything different. We just talked about FIFAs. In Georgia, we call it a deed to secure debt, because in Georgia, it's actually the buyer is giving a deed to the bank or lending institute for the property, and that deed says that once the debt is paid, the creditor will deed the property back to the borrower, or will cancel that that deed. Okay. Now let's talk about mortgage foreclosure. When a person defaults on their mortgage, the lender then has the right to foreclose on the mortgage property. It's actually called accelerating the loan. So there'll be a clause in your mortgage that says that should you default in one payment or any of those other obligations like insurance, maintaining the property, then the lender can declare the entire amount immediately due. And if you don't pay it immediately, then they have the right to foreclose. Foreclosure is usually not good for the bank or the borrower. The bank, it can result in a loss of money, and obviously the same is true for the borrower. So usually people try to avoid that, and lending institutions also try and avoid that. There are two types of foreclosure, judicial and non-judicial. In judicial foreclosure, the lending institution has to actually file a lawsuit against the borrower and get a court to agree that the borrower has defaulted and give them an order allowing foreclosure. Georgia has provisions for what's called non-judicial foreclosure. In Georgia, the lending institute declares the loan in default, accelerates the amount due, and sends a notice to the debtor saying that they have done so and that they are going to non-judicially foreclose on the property. And the rest of the procedure basically is that they have to advertise this in the local legal organ newspaper for a period of time, and then the property is sold by the creditor on the steps of the courthouse in the county where the property is on the first Tuesday of the next month after the ads run. Okay? And anybody can buy it for whatever price there is, and that's how that works. Normally, or not normally, but many of the times it's the bank that ends up buying or taking the property, the lender that is. Ways to avoid foreclosure. Forbearance is one. This is where the debtor gets the creditor to agree to hold off on foreclosing for a period of time. Usually this occurs when the person is having a situation like may be occurring now with the coronavirus, where people can't make their payment now but expect to be able to do so within the next 2 or 3 months. In that situation, it's to the advantage of the bank or the lender to work something out with regard to a forbearance, so that in the end everybody ends up in a better situation. Okay, a workout agreement is similar to that. This is simply where they sit down together and work out some plan. It might involve paying back a certain amount each month for the month that was missed or the months that were missed, whatever that may be. Okay, a short sale is another option. Short sales were very, very common back around 2008, 9, and 10 during the Great Recession. In a short sale, the buyer or the person borrowing the money has defaulted, and foreclosure is imminent. Okay, in that situation, the borrower can approach the lender and say, can we do a short sale, which basically means that they will voluntarily convey the property to the bank in exchange for the bank nullifying the debt. So the property stands basically for the debt. Obviously, you can see in that situation, the lender is probably going to take a hit because it's unlikely that in a period of recession that the real property is going to sell for enough to cover the loan. However, when you factor in things like the cost of the sale and all those kind of things, it's oftentimes in the bank's best interest, rather than to have to deal with the foreclosure process, to simply agree to a short sale. Okay, now there's some protections for debtors that exist in the law. We're going to get into those in the next part 3 of chapter 15. For now, let me tell you that the magic word for chapter 15 is bankrupt. So we'll pick back up again with this slide on part 3.